what we've worked to do is position the portfolio to be in a good spot to benefit from some of the trends that are going on, benefit what's happening in the market, manage the risk, but also to take advantage of the opportunities that I think we've seen that bear out well in the numbers overall. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, here we go. We're back. It's Friday. Bit of a mixed week in markets, kind of back and forth with everything going on. We got our golf shirts on today too. I got some new Aretec apparel that's hot off the press here for the golf game. But how you doing over there, Greg? What's going on? Looking forward to getting out on the links this afternoon.
Yeah, just it's pretty much my annual golf game, but should be good. But Will, I can't help but notice one of those shirts hasn't made its way across to me, so I'm wearing my own stuff, but not the Aretec gear. But
yeah, it's in the car. We have an order of them, so it's in the they're in the back of the car. So yeah, we're going out to a client's golf tournament. So we've got an Aretec foursome, and we're sponsoring the tournament. So we figured we had last year's edition of the golf shirt, which was the white with blue. Now we got navy with white. But figured we'd tell the story, support the community, get out on a Friday afternoon. It looks like it's going to be a nice day, hopefully, all things considered. But have you been to the range at all?
So for these annual games, I do like to go to the range just to loosen up the swing a little bit, just make sure the mechanics are working, but I haven't had a chance to, so it might be a little bit rough on the first few holes, but I'm sure I'll get into the groove quickly.
I think it's the best ball type of format. So
perfect.
I'll pick you up, or Roman will pick us up, I'm sure, right? If you're lagging, but anyways, perfect. All good. Should be a fun afternoon, and look, we wanted to come on, just give you a bit of an update on the story on markets, the portfolio, what's going on out there. It's been a little bit more mixed. We've had a few comments from clients saying, all right, we're looking at things, they're off a little bit. There isn't necessarily any major news, although you still have the geopolitical stuff. We've got this on again, off again war. We can't really entirely make sense of that and what's happening, whether the strait is open, it's closed. I mean, I think the war's back on right now, so you've got some risk there, which is factoring a little bit into markets. But I think the bigger story, which kind of ties in with it, is the whole inflation and interest rate and Fed story, which I really think when we look kind of the first half of this year so far for 2026, that's probably been the bigger story. Is new Fed chairman Kevin Warsh more hawkish. There's probably some credibility back in the Fed here, where the markets are believing the Fed that they're not going to be taking interest rates down to zero, and that's done things like push the U.S. dollar up. Inflation expectations have come higher. Interest rate expectations have come higher. Those sorts of things. So that's really the market story we're seeing. And the last few weeks, or the last month or so, even June, July, that's what's been driving markets here.
Yeah, and especially this week, Will, to your point, the war seems to be back on, at least for the time being, but the markets aren't really reacting or responding. You didn't have a major sell-off this week because of the news. So it seems like the markets are moving past the geopolitical stuff and kind of more focusing on, okay, what's happening with interest rates, what's happening with inflation, what's the jobs numbers looking like, what's the Fed saying. So do you think, Will, kind of going into this back half of the year, those factors are going to be the main catalyst and the main drivers?
Yeah, I think so. I mean, I don't think, look, markets, we never know what the unexpected pieces, but it's honestly probably a healthier market if it's being driven by the Fed and inflation and interest rate expectations and what's actually happening in the economy versus these external shocks, whether it's Trump, tariffs, war, COVID, those sorts of things. it's a more normal, a more stable market if the story is, all right, how hot's the economy running? Are things heating up? Are they cooling? Are interest rates going to go up or down? And I think that's a lot of the markets trying to figure out whether there's still some calls out there that there's going to be cuts on interest rates, but the expectations certainly have been tempered where it looks like, if anything, rates are going to be stable or stay steady for longer. And I think that's really going to be what's driving the markets. And it also ties in. I mean, we have a decent or pretty healthy exposure to commodities in general and the natural resources, which is an area we like. But all these things happening, they kind of will tie in, because when we've got the geopolitical conflicts heating up, some of the last positions or some of the more recent trades that we've made in the portfolio were geared more towards buying some energy, some oil and gas on the pullback that we saw off the incredible rally in the early part of the year. And so you're seeing that kind of ebb and flow. You're also seeing gold is really tying in with this interest rate story, which we've been constructive on gold for a couple years now, and have been telling that story. And this year, it's been more stuck in the mud, so to speak. And earlier in the year, it was flying high for sure. But then once you had the new Fed chairman Kevin Warsh come out, it market all of a sudden turned hawkish. It meant rates are going up. Potentially, it meant the U.S. dollar is going to go up, and gold's been trading for quite some time as more as this alternative type of currency, a different reserve currency. So people thinking that U.S. dollar is going to go up actually strengthens, means more money's going in the U.S. dollar, potentially out of gold. So that's one of the things that ties in with that trade as well. So a lot of interesting dynamics, but I do think what we're seeing now is a little bit more of a normal, healthy market, at least not as headline or as dramatically driven right now.
Yeah, I think that's welcome for everyone. So I guess, Will, just big picture. So the story is inflation, interest rates. Why is that so important? What's happening with inflation, interest rates? Like, why is that so important to the markets overall?
I mean, it's probably the single biggest factor that's gonna drive things, and a lot of it ties in with the growth stocks and the technology stocks, because they're very correlated, heavily correlated to the interest rate story. So if you run into a situation with growth and tech stocks where rates are going down or staying stable or generally in that direction, that is a catalyst for just valuation, overall just investor sentiment and demand. If you have a stable declining interest rate environment, very, very good for technology, and particularly that growth part of the market. And let's say 23, 24, 25, and most of 2026, that's largely been the story. If you go back, the more recent history and more recent memory is 2022, when we had inflation fly up to high single digit, low double digit type numbers. You had interest rates, borrowing costs essentially triple through 2022 and 2023. And through 2022, that sent growth stocks in the NASDAQ into a tailspin where it was down 30-40% in that range. So growth, the tech stocks, really the more maybe say speculative area of the market for sure is largely driven by the interest rate story. So if we run into a situation where inflation starts running away, which some of these signs we've seen, they're kind of mixed, right? Like last week, we had bad jobs numbers, so that probably means inflation's not as hot. But then Canada, as an example, this morning had pretty good jobs numbers, so that's mixed. But inflation prints that we've seen, you're not down at 2% like we saw in the pre-COVID area. This inflation looks like it's sticky. It's going to be hanging around. If inflation hangs around, it means there's a potential there for Fed rate hikes, which is going to put pressure on these growth and technology areas of the market. So it's all tied together for sure. It's a complex web, but we're trying our best to make sense of it here for you.
Yeah, that's a good way to put it. So, well, would you say, going back to 2022, to your point, was one of the challenges and why you had that big tech sell-off is because inflation just ran away from the Fed, and the Fed kind of had to backtrack and hike rates like pretty aggressively, where if now, even if rates are going up, if it's a little bit more of a measured approach, that could potentially be better for markets than the escalation we saw a few years ago.
Yeah, I mean, there has to be some strength, some credibility, some just good management from the Fed. And I think the problem in COVID is that yes, COVID was this massive external, exogenous type of shock to the whole market and system, but things just exploded coming out of that. All the demand and changing demand and all the constraint supply chains and everything that was going on put all this pressure, and rates were kept too low for too long in the COVID days, and then they had to play catch up. And the Fed, the whole thing, if you remember, transitory inflation, transitory. I mean, I think that was shown to be a real issue because it wasn't transitory. I've said for a few weeks now the inflation's very sticky, right? It's not like just dust that gets in there and you dust it off and the inflation's gone. It's like it's it's sticky, right? Under the seat cushions. It's in the rug. It's going to hang around there for a long time. So you don't just brush it off. And so I think that's what you need to see here is the messaging from the Fed. It's got to respect that. It has to be watching that. And I do think if it's a more measured approach, because there's been lots of periods through history where interest rates weren't moving up that far and that fast. And the other thing, if that's the environment we're going into, being more in value stocks, dividend stocks, these real assets, hard assets, commodities, natural resources, things like industrials. That's another area. Energy. Not that you don't want to own the technology. I mean, we've had our fair share of tech and have participated in that. But remember that the technology sector is close to 50% of the S&P 500. The NASDAQ, it's significantly more than that. And the TSX, it's much lighter, where you're in the 15% range is the technology exposure. So what you want to have here is a little bit more correlation to the TSX, the good old fashioned Canadian market, a little bit less to the growth, the technology sphere, because I think that's where a lot of the risk is in this market environment.
Yeah, so it's interesting. 5 years ago, 2021, it's interesting. The inflation levels that we're seeing today were very similar to what we were seeing 5 years ago. But to your point, Will, the message from the Fed was, this is transitory. This isn't going to last forever. But then you just saw inflation run away, and then rates had to go up to counteract that. Where now it's probably healthy for the market that they're saying, look, inflation's a little bit higher than we'd like it to be. We're going to probably take a hard look at raising rates. That could actually be a positive longer term.
Yeah, if it's measured, if it's controlled, it's done well. I mean, Fed chairman is not a easy job for sure, and we've seen in this the last couple of years. I mean, not it's kind of died away because there's a new Fed chairman, but there was all the pressure from the White House of lower rates. It seems like, or at least let's put it this way, the market is perceiving that this is an independent Fed. It's more hawkish. They're making their own decisions. They're doing what's best for the economy. So that's a good thing. But we know that Trump's a wild card. Who knows? He can change his mind very quickly. He might turn on this Fed and start talking about lower rates, and they need the stimulus and all these things because ties into the politics and midterm elections. And we've seen it with all the geopolitical stuff. It's very unpredictable. So we've said for a long time, you got to kind of expect the unexpected and be ready for anything when it comes to this market, this world for sure.
And so, what would your message be to investors? Will, we're more than halfway through the year. Portfolios are in a good spot. As we said, probably new drivers are going to be moving the market going forward. What would your message be overall at this point?
I mean, same as always. Not not changing too much, but we want to stay the course, stay with the process. We've been focused this year a lot more, I would say, on positioning of the portfolio, meaning strategically being in the right pockets, right sectors, right areas of the market that we feel a little bit, say to the midterm and long term are going to benefit because There hasn't been, I mean, there was all the war geopolitical stuff, but there hasn't necessarily been big changes in trends or shifting leadership or anything along those lines. It's more been sticking with the process, sticking with the leadership, sticking with the areas of the markets that are working. And I mean, I don't think it is summertime. It tends to be, I would say, a little bit quieter. Probably knock on wood to say that, but it tends to be a little bit quieter. But I mean, in terms of noise, I don't think as we move through the rest of the year it's going to go away. We got the U.S. midterm elections. We still have this war in Iran that's still going on and is still a risk. And then we've also got inflation and interest rates, the Fed to worry about, amongst other things. So I don't think it's necessarily going to be a calm, smooth sailing. But what we've worked to do is position the portfolio to be in a good spot to benefit from some of the trends that are going on, benefit what's happening in the market, manage the risk, but also to take advantage of the opportunities. And I think we've seen that bear out well in the numbers overall.
Yeah, and there's been a lot of noise. To your point, Will, about position. There's been a lot of noise so far, and probably as we move through the rest of the year, the markets are going to look to each data point, inflation, interest rates, jobs number, and you'll probably get some volatility. So it probably makes sense to look a little bit more longer term and make sure we're positioned in the right areas.
Yeah, for sure. But it's always interesting out there. Keeps us busy on this end, and ultimately it's all about, we want you to be wealthy. We want your portfolios growing, moving in the right direction, managing the risks of the market, seeing your net worth go up overall. We also want you to feel wealthy, so we want you enjoying life, enjoying retirement, maybe getting out on the golf course once in a while. We're like once a year over here, but yeah, just having a good time, not worrying about money, not worrying about the markets, the world. We want you to realize your wealth. That's what Aretec Wealth is all about. You could see it today right on the new
There
golf
you go.
shirt. So we'll be back with everybody next week. Enjoy the summer weather, and we'll talk soon.
Talk